All right, friends. All right, friends, we're gonna let this last person in here for a little bit. So, hello, hello. I am Michelle. I am your chair of EXP MillNet. If you go back a few videos, I'm gonna say I'm the education director. In another video, I'm gonna say I'm the co-chair, but I'm the chair now. So, hello, welcome. I'm so glad you guys are here. Um,
You're
You're on
you're
mute,
you you're
Michelle.
muted.
Why did I mute? I'm like it popped up in my screen. I'm like, what the? Oh my gosh. Okay. I'm gonna start over because I don't know what you guys heard. Anyway, we're here to learn about tax strategies with Garrett Maughan. He's from Prime Corporate Services and he is just super awesome. And I'm so excited to hear all of the things because, like I said when we started, like it's not about how much you make, it's about how much you get to keep. So we as realtors need to be super, super savvy with our taxes because you guys, the more we make, the more Uncle Sam tries to make, and we just can't have none of that stuff. Okay. So, Garrett, take it away. The floor is yours.
All right. Thanks, Michelle. Well, everybody, this is exciting to be with you. My name is Garrett, and I'm a tax attorney with Prime Corporate Services. So, what does that mean? How is that different from a CPA? A CPA, many of you have probably had an opportunity to work with at some point, unless you do your own tax returns. CPAs do really well at helping you take your numbers, take your tax documents, and they help put that together into a tax filing. Now, what you probably have not experienced with a CPA is a CPA, they typically don't give you proactive tax advice or suggestions on strategies you can use in your business or with your real estate holdings, with your activity to be able to help decrease your tax liability. As Michelle was saying, as your businesses increase, as your activity increases, that of course brings an increase in income. Increase in income translates into more taxes. That doesn't mean that you have to pay more taxes. Okay. There, I had a professor, first day of law school. She shared with everybody a phrase, a sentence that has always stuck with me throughout my career. And I've been doing this for a very long time. He who knows the rules the best can bend them the farthest. That doesn't mean break everybody. But I want you all to think of the tax code as a very large, huge amount of law. But if you know where to look within the tax code, you can find exemptions, exceptions, exclusions, how to be able to decrease significantly the amount of taxable income that you have. Not all income that an individual taxpayer or married couple, not all income that you earn is considered taxable income. There are various ways that income, is calculated within the tax code. But taxable income is the part that, as tax attorneys and CPAs, is the part that we really look at to be able to focus on how can we make a positive impact on that. We're going to talk about that today for each and every one of you. And I promise everybody, I will do my best not to put you all asleep. I know taxes are everybody's favorite subject. They're super exciting. I get stoked about them. But then again, that's what I do for a living. So even my wife has learned over the years not to ask me, what did you do at work today? She learned that's a rabbit hole to go down and she doesn't want to go there. So instead, she just asks how it was work. So, um, well, let me share my screen with everybody. I've got some slides that I like to be able to share here. And if I can do this honestly, everybody, without getting a 10-year-old involved, then it's a big win for me today with technology. So here we go. Is everybody able to see this? Nice big blue screen here.
Yes.
Okay, so today we are talking about real estate and taxes. Okay, strategies and considerations. Just quick legal disclaimers. Yes, I am a tax attorney. That doesn't necessarily make me your tax attorney. Okay, so what we're going to have today is just an open discussion. There's going to be a lot of opportunity for everybody to ask questions. So I'm going to talk about a couple things, but I definitely want everybody to feel very uh, open. I want everybody to feel that you can ask questions about maybe your own business, what situations you have, what are going on. Okay, but nothing that I'm going to be telling you should be taken as legal advice. This is just open conversation, sharing with you some information that could be very beneficial for all of you relative to the tax code and how you can make a positive impact on your own situation. So again, as a real property owner, as a business owner, the more income you earn, the more financial success you achieve. Of course, that translates to more taxes, more income that you have. 8 areas that, if we have time today, we're probably not going to get to all of them, but areas that I want everybody to be mindful of that you can have an impact within your tax situation. Maximize business structure and entities. A lot of people don't think structuring the way that you structure your business or structure your real estate holdings, that has tax impact. There are ways that you can have a positive tax impact the way that you structure your business or your holdings. Of course, if you have a business, maximize your business deductions, business expenses. And this is a big one that we're going to make sure that we talk about today. Many of you have heard about reps or real estate professional status. This pertains to what is called material participation in the tax world. If you have a business or you're trying to take advantage of business expenses, the only way to be able to take losses where your expenses exceed income on that type of activity, in order to be able to unlock those expenses, those losses, you have to have material participation. And we're going to talk about that in great length because reps and material participation is a huge, huge factor when you're dealing with real estate. If you don't have material participation with your real estate, by default, that real estate activity is considered passive. And in the world of tax, passive activity does not mix well with active activity. Passive and active, think of them as like oil and water in the tax world. There are restrictions when you have a passive activity. And in order to unlock that, we need to have material participation. There are some timing, strategic accounting methods you can utilize. As a business owner, your business can sponsor benefits for you, the owner of that business, or you could even be, in some situations, considered also an employee of your business. And just like any business, that business can sponsor benefits for you. We'll try and talk about that. Retirement contributions, utilize available tax credits. Okay, we're going to talk about the difference between a deduction and a credit that are treated a little differently within the tax world. Knowing how they're treated, that can help you focus on where do we want to be able to utilize those for tax benefits for you. Active and passive income shifting. You can shift potentially using certain strategies. You can shift income out of your business to a family member, kids, for example. Kids have a lower tax rate than mom and dad do. And so you can utilize your kids as a tax strategy. And then, of course, itemization versus standard deductions. Okay, so let's jump right in. And again, if anybody ever has questions, okay, feel free to just jump right in. Okay, this is going to be I want this to be a very open conversation with everybody. I don't want to just drone on and, put all of you to sleep here in the first 20 minutes. Okay. Whenever you're looking at taxes and a business, there are two things that you want to always take into consideration. Am I creating a business? Am I utilizing the right structure for asset protection? And how can I do this for tax efficiency? There are two questions that you always have to answer, and they overlap a little bit. Okay. But many situations, they don't fully align with each other. And so many times when you're looking at, especially in real estate, looking at your business, looking at real estate holdings, how you're going to hold or own your real estate, you have to ask yourself these two questions. Do I want to set up a business structure for the purpose of asset protection? And in real estate, asset protection is huge. If you have a rental property and you have a tenant on that rental property, you have liability from a legal standpoint. If that tenant were to get injured on your property, you are now potentially liable. You have to be able to protect yourself. In order to do that, you can use a business structure. Simplest and easiest business structure is the LLC, the limited liability company. Now, not always does tax efficiency perfectly align with asset protection. There are situations where you have to balance the two. And we're going to talk about that a little bit today. Okay. There's many types of entities. Whenever you're looking at starting an entity, opening up a business or an entity, again, these questions of asset protection versus tax efficiency. That helps you determine what type of entity that you want to be looking at. Single member LLC is the easiest entity to be able to form and maintain. Now, single member LLC means that it's just you. You are the only owner. You don't have a partner. You don't have a spouse that might be a member or a member manager. Okay. If you have a multi-member LLC, that gets treated differently under the tax code than a single member LLC. Okay. Many of you have heard of many of these types of entities: sole proprietorship versus a partnership versus a corporation, C corporation versus an S. You have general partnerships versus a limited partnership, single member LLC versus a multi-member LLC. Not all entities are created equally. Each one of them gets treated differently under the tax code. Now, here's something to think about, everybody. Limited liability companies, they exist in this dual universe state. They are created under state law. They are an entity, they are a beast that is created under state law. That's one universe. How they are taxed is a completely different universe. In the eyes of the IRS, an LLC doesn't exist. A single member LLC, that's not something that they use that terminology. Rather, they call a single member LLC a disregarded entity. So for the purposes of tax, we're going to use this phrase, disregarded entity. What does that mean? It means the IRS considers that LLC to be no different than you, the individual taxpayer. They don't even consider the LLC to be a business entity separate from you, the individual. How does that differ from a multi-member LLC? Again, the IRS does not consider an LLC to exist. So what is a multi-member LLC? A multi-member LLC is considered a partnership, and partnerships are treated very differently in the tax world compared to a single member LLC or disregarded entity. Now, of course, a partnership and a disregarded entity, those are very, very different from a corporation. And in the world of the IRS, those are the only three entities that exist: a corporation, a partnership, or a disregarded entity. Knowing your business and how you are classified in the eyes of the IRS, you can maximize how am I being taxed. And if you know the pros and cons about each and every one of these, and we're going to talk about them here just really briefly to give you guys an idea, kind of a primer. Okay. So, disregarded entities, they are, as we've heard, sole proprietorship. It's you individually. Whenever you earn a dollar in that business, that dollar is subject to what I like to call additional tax, or also known as unnecessary tax. Many of you have heard of the employment tax, self-employment tax. Self-employment tax is an extra 15.3% tax on that dollar that you earn in that business. Now, that's on top of your ordinary income tax rate. How many of you have heard of tax brackets or maybe even marginal tax rate? Forget about it. We're not talking about tax brackets or marginal tax rate. The reason why, they are calculated very squirrely, for lack of a better word. They're tiered. You have a step system. The first 12,000, they get taxed at a certain tax rate. From 12,000 and a penny up to the next 53,000, you get taxed at another different tax rate. Every step up in income, they get taxed at different tax rates. That is not, marginal and tax brackets are not a good way to measure the health of a business or an individual. So rather, we're going to use effective tax rate. Effective tax rate is on every $100 of taxable income that you earn, whether that be individually or as a business, you pay, in general, total, all things considered, you pay a certain amount of tax. For everybody, your effective tax rate will be less than your marginal or tax bracket rate. So don't get hung up on, well, my accountant told me I'm in the 34% tax bracket. That just means that on the higher tier level of the amount of income you earn, you're paying 34% on that higher tier level. But that doesn't mean that you're paying 34% on everything that you earn. More likely than not, people here on this call today are probably anywhere between 14 and 30% effective tax rate. In fact, I'll dive in a little deeper on that. In my 22 years of doing this and working with clients and customers, most people who have a business land somewhere between 23 and 29%. If you are outside of that window, that tells me one of two things. If you're outside, you're above 29%, it tells me you've got something going on in the background that is hindering you. More likely than not, you're probably a single member LLC being taxed as a sole proprietorship, and you're paying extra 15.3% on top of whatever your effective tax rate is. So if you have an effective tax rate of 15% plus an additional 15.3 on your business, you're now paying 30.3%. Okay. Clear as mud, right? Everybody so far? Yeah, sure. Some people, no, no, not at all. Garrett, you lost me. Okay. So if you are a sole proprietor, if you are a single member LLC, you're setting yourself up already for unnecessary tax burden because that income that you're earning in your business, you're paying an extra 15.3%. So many of you are now thinking, well, Garrett, what the heck? How do I work a way around this? Look at your structure. If, and this is an if your business income rises above a certain level to where it becomes really effective to change the way that you want your business to be taxed, you can make what is called an S corporation election. That does not mean that we are going to change your LLC and completely revamp it and turn it into a corporation. That's not what you're doing. You still have a single member LLC. What you're doing is you're telling the IRS, I'm making more income than I did when I first started my business. And now I'm at an income level where, yeah, it makes sense for me to tell the IRS, treat me a little differently. I want to be treated as an S corporation. What that does is, as an S corporation, you now have two different roles within your business. You are a owner of that business, and as an owner, you can compensate yourself through distributions. Distributions are not subject to the extra 15.3% employment tax. They come out just at ordinary tax rates. The other role that you play in an S corporation, you are now a W-2 employee. You're an employee of the business. As an employee, you have to pay yourself a reasonable salary. Of course, the IRS is going to say, well, we're not really going to give you, guidelines on what is reasonable. We're going to leave that up to you, taxpayer, to try and figure out what that is. But let's use a scenario here, everybody. If you have a business that brings in 100,000 of net income, now this is net, meaning you've paid yourself a salary, you've now paid all your expenses, you have your business deductions, what you're left over at the end of the day after all of those expenses, that's your net. That's what you take home. Let's say, for example, you're bringing in 100,000 net. You can pay yourself, let's say 20,000, a salary of that 100,000. W-2 wages are subject to employment taxes. But here's the benefit. The business has to withhold half of that 15.3% on you, the employee. The business withholds it and pays it on your behalf. That's your burden now as the taxpayer. You're at half of that 15.3% on 20,000, not on the full 100. The other half of that employment tax, the business is responsible to pay, and the business gets to deduct that. You get to take that as a deduction. So it helps even further to decrease your bottom line in the business. Garrett, what about that other 80% off that 100? You can take that as a distribution. and that distribution is not subject to the extra 15.3%. So using an S corporation election, we've now made a drastic change in that unnecessary 15.3% that you were paying on beforehand that was jumping you up to potentially a 30% effective tax rate. Now, an S corporation doesn't work for a brand new business that maybe you're bringing in $1,000 or $2,000 at the end of the year after all your expenses. It's not effective or efficient. The reason being, an S corporation has to file a separate tax return. So in addition to your own personal 1040 return, now you have to file an 1120S return. So there's some extra fees there. 1120S returns, they're not straightforward. You can't get yourself a copy of TurboTax or H&R Block software and do them yourselves. You can learn how, but they're more complicated than just your normal 1040 tax return. CPA is probably going to charge you about $1,000. As a W-2 employee under your S Corp, you have to pay yourself a W-2 wage. That translates, you have to set up a payroll service to be able to pay you and withhold on that employment taxes. So there's a fee there with payroll. So only when the business is now starting to make a certain threshold of net income does an S corporation election make sense. That's typically anywhere about north of 60 to 65,000 of net income in the business. So if you rise to that level and you've got business income of that level, seriously consider looking at making an S corporation at that time. You'll see a drastic impact. Okay. Well, Garrett, what if I start up a real estate company with my spouse and we form an LLC and it's a multi-member LLC? That's awesome. You can do that. You're a partnership. How are partnerships treated? In a partnership, by default, you are both general partners. Under the law, general partners are fully liable for everything that goes through the business, in the business, out of the business, and all of your interactions with everybody else. The assets within your business are subject to liability. So by default, unless you do something, your partnership with your spouse, you have high liability. So you've got to do something to be able to protect yourself. Again, these questions of how do I protect myself from an asset protection perspective, but how am I also tax efficient? Partnerships they're great because you can pay yourself via distributions. Again, distributions are not subject to self-employment tax, except for if you are a general partner, which by default you would be unless you do something extra, and you provide services to your business, meaning you are working on behalf of your business. Technically, the compensation you receive from that partnership is now considered a guaranteed payment. Guaranteed payments are subject to self-employment tax. I want everybody to take note of this because this is one of the hidden, wait, what? Why are we paying ourselves guaranteed payments? I would say easily 99 out of 100 taxpayers who are in a partnership, their accountant never tells them, oh, by the way, you're getting a guaranteed payment, you're having to pay extra self-employment tax. This is one of those surprise things that I find all the time working with customers and they're not aware of it. So how can you work your way around that? Rather than set up a general partnership by default, be proactive and create that business entity as a limited partnership. You and a spouse, a friend, a buddy, you can be partners, but take it an extra step where you have a third party, that could be a single member LLC, has a very small ownership in that partnership, maybe 1%. That third party could be the LLC. You designate them as the general partner. They're only a 1% owner, so they're only getting 1% of any of the income, gain, loss, deductions, credits, very small, very nominal. General partner has to take on those guaranteed payments, but you and your other partner who are now limited partners, two things. Number one, you're limited. Under the law, you're not liable for any activities that happen out of the business. Someone could sue your partnership and they can't go after you because the two of you, you're limited partners. You're not general partners. Also, limited partners do not receive guaranteed payments. They receive compensation as distributions. So you're able to eliminate that self-employment tax. I want everybody here to be aware of how important structuring is and making decisions regarding how you structure your business so that you don't have some hidden surprise when it comes tax time. Okay. Another thing to consider, do you own multiple pieces of property? Let's say you own 3 or 5 pieces of property, various different rentals. Maybe you've got a couple single family, maybe you've got a duplex, maybe you've got an apartment complex that has maybe 10 doors. Please, please, please do not own all of those pieces of real estate under one LLC. Please. Can I say that again? Please. You are setting yourself up for liability. If you have a tenant that has a slip and fall on one of those properties and all properties are owned under the same LLC, all properties are now up for grabs in that liability case. When you have a portfolio of multiple properties, you want to structure in a way to where those properties are separated. They are held in separate LLCs. Now, you can have those LLCs, you can have them held and owned by a parent company. Some people call it a holding company, some people call it an umbrella company. As you have those single member LLCs holding those various pieces of real estate, they're shielded, they're protected within that bubble that that LLC creates for the property. From a tax perspective, though, all of that income, all of those expenses, they pass through, they flow up to the holding company, to the parent company. And that's where you're able to realize that income gain loss deductions and credits within the tax world. So you won't see a very drastic change in your tax perspective, but with a little planning, you can definitely make a positive impact on your liability and asset protection. So always, always, always ask these 2 questions. Do I have liability? How can I protect myself from that liability? And how do I want to be most tax efficient? Okay. So if you have multiple businesses, divisions, multiple properties, how are you structured? And what I like to ask customers that I work with when I look at some more of these complex structures, do your entities play nice together? Do they interact with each other? I'll give you an example. You have you've got a real estate business, maybe a brokerage or, traditional sense of realtor that you are, helping customers buy and sell properties. That is your operations business. That's your operations entity. Now you also own properties. You've got various properties in your own portfolio. If you own your office space, if you own your building, how do you own your building? Is that held in your operations business? Do you hold that individually yourself, or do you have that in a separate LLC? If you have that property in a separate LLC, do you have a rental agreement between that LLC and your business operations, your operating business? There's a tax opportunity there to where you can have a lease back and forth. Now, granted, yes, you're basically shifting income. Your operations business is paying lease income, so that's an expense out from the operations. You then have income flowing to the LLC owning your business. So there is income there at the business LLC or at the building owner LLC, but there are ways that we can zero out that income to where there is a net zero in that LLC and there's no tax being realized in that LLC. Having agreements, contracts, whether that be a management agreement, services agreement, a lease agreement between your entities, that you can internally generate opportunity to be able to create business deductions. You can also, as need be, if you ever need to shift capital from one entity to another entity, you can do so, again, using a distribution out of one entity. You then contribute that capital into another entity. That's called a capital contribution. These are tax-free events, taking a distribution, making a capital contribution. So there's a way that you can shift and move income around. Now, granted, don't just start pulling money here and there willy-nilly and start shoving it into various accounts. You do need to be strategic, and you very much need to be keeping books and records. Income in, income out. Keep track. Heaven forbid if any of you are ever audited, the IRS is going to ask to see where's the money coming from, where's it going. You have to be able to document that. And the key to winning an audit is document, document, document. If you can document and show that I did this step in good faith, and you can show in good faith that I did it this way, under the tax code, there is a presumption that you did so without doing so with the auspices of fraud or trying to hide something. That's where the tax code comes in, and that's where people get in trouble, is when you're trying to hide things. But if you're not trying to hide and you document it properly and you're able to show in good faith, yeah, I was moving income from one business to another. I did so with a distribution to me, the owner. And then I took that and I made it as a capital contribution into another business. Okay. Not just shifting from one business straight to another. You have to take steps to be able to do that properly. Okay. We spoke about this earlier as we started. He who knows the rules the best can bend the rules the farthest. Under Section 61, gross income. Now, this is Section 61 of the tax code. I do not expect any of you to run out and pull up a copy of the tax code and start reading it. If any of you have trouble sleeping at night, granted, this is an excellent solution to help with that, okay? My wife jokingly tells people that I put our kids to sleep reading the tax code. If that were the case, that'd be awesome. My kids would be brilliant, but I don't do that. Section 61 of the tax code. This is the number one. I mean, all rules in the code come back to Section 61. Gross income includes all income from whatever source derived. I want everybody to think income does not mean cash. Income is anything that has a valuation of wealth clearly realized. Okay, that's just fancy tax code for saying if you get something from somebody in exchange for something else, whether you provide a service and they pay you cash, whether you sell a product or an item and you receive something in exchange. A really good example, I work with a lot of individuals from various different backgrounds. A physician I worked with years and years ago, he called me up and he asked, Garrett, I did a surgery on a patient and they couldn't pay me in cash, but he owns a trampoline company. He asked if he could pay me in trampolines. Well, how many trampolines did you receive? Well, I got 3. I got 1 for my family, 1 for my nurse, and 1 for my office manager. Do I have to report that? I mean, that's not money. I mean, I didn't get anything. Well, John, what's the value of the trampolines? Yeah, the guy told me they were worth X amount. Okay, what was the value of the surgery that you performed? Oh, that was a lot. Okay, well, you just got 3 very expensive trampolines because that's the value of the exchange of the service that you received. So don't always think in terms of cash. Think in terms of money. Think in terms of, did you receive something of value in exchange for something you gave up? The tax code tries to address these situations. Now, again, gross income includes all income. If you go to a yard sale and you buy a piano from somebody, you get that piano home and you call a piano tuner to come over and tune your piano because it sounds really muffled, it's not working very well. The piano tuner opens up the piano and finds that there's 10,000 cash hidden inside that piano. You've just realized a significantly more income than what you thought you paid for that piano. You know, maybe you bought it for $100, but now you just realized 10 grand because of a treasure trove that was hidden inside the piano. That's actually a Supreme Court case back in the 1890s. And the question was, is that income? Is that 10 grand income? The answer is yes, because they came into acquisition of it. So you have to always wonder, what did I receive in exchange for something else? But not all income is taxable. And that's how we look within the code for these exemptions and these exceptions. So first and foremost, if you have a business, you have expenses. I guarantee it. You have expenses, whether that be operations, payroll, supplies, materials, advertising, the list goes on and on. The tax code cannot be written in a way to name and address each and every item of potential expense. You, as a taxpayer, you get to decide, is this an item that I can deduct in my business? Under Section 162, any item that is ordinary and necessary in the day-to-day operations or ongoing of a business, that is a business deduction. That is an expense deduction. So I want all of you to start thinking at the world, looking at the world through this lens. Is this ordinary and necessary related to my business? If I go on a trip, and if maybe I go to North Carolina to the Outer Banks, and I'm going there for 7 days on a vacation trip with my family reunion trip. But I'm going to spend one of those days going around Outer Banks, and maybe I'll meet with a real estate professional there, a realtor. Maybe I'll go look at a couple open houses. Maybe I'll check out some listings. Maybe I'll look and see if there's a property, that I might be interested in purchasing. Now, whether I do or not, that's a different story. You don't have to actually purchase something. But if maybe I spend one of those days of that trip engaged in business activity related to my real estate business, have I just created an expense deduction? Michelle's nodding her head. Yes, you have. You have created a business opportunity that is ordinary and necessary, related in your business, to where you now can deduct a portion of your trip expenses. I want every one of you to start thinking in this idea of, is this ordinary and necessary? If I have to make a purchase for technology, maybe I have a laptop that died and I've got to run out to Sam's Club or Costco, I've got to pick up a new computer. If it's being used more than 50% in your business and you're putting it into business usage in the year in which you purchased it, that is an expense deduction that you can deduct in your business. If you have employees and to appreciate your employees, you take them all out to dinner, nice restaurant, and you foot the bill and the business pays for that bill, that's an expense deduction. That's related to your business. Now, food is one of those tricky rules. You can't deduct 100% on food. You can deduct 50%. But knowing where to look, whether this is ordinary and necessary, if you can answer yes to that question, you have a business expense deduction. Now, expenses are great. Everybody has expenses. I guarantee you, you're incurring expenses related to your properties, related to your business. But if you are not tracking and recording those expenses, then you are missing an opportunity to be able to realize those expenses when it comes time to prepare your returns. So everybody, please, please, please come up with a system that you are using to be able to track those expenses. Now, that could be any system. Many people ask me, well, Garrett, what's the best system to be able to track my expenses? Honestly, everybody, whatever system works best for you. Many people ask me, Garrett, do I need to get a copy of Quicken or QuickBooks? If you are the type of person that you will carve out the time to sit down and you will enter those line entries in Quicken and QuickBooks, and that software makes sense to you, newsflash, everybody, Quicken and QuickBooks is not the most user-friendly software. And if you find yourself being frustrated with that software, I would recommend look for something else. If you are a spreadsheet person and you like to use Excel spreadsheets and that works well for you, perfect, use that. If you are a 92-year-old couple who comes to me with a banker's box and they've saved every paper receipt in that banker's box, and they have an accountant's ledger book from the 1930s, and the husband has handwritten every entry on their rental property over the course of the year in that ledger book. If that works for you, then that's the best system you have. This couple, Jack and Yuki, they had a the two of them have passed away, but they had a rental property in Malibu, California, up on a hill in Malibu. It is a beautiful white stucco property. If any of you enjoy the magazine Architectural Digest, you have seen that property. It has graced the cover of that magazine 3 times in the last 30 years. Very well income producing property. They acquired it in the 1920s when you could buy property for literally, I think they bought the property for maybe $700. Okay. And to hear them tell me about this story, I was just blown away. But Jack would record every expense related to that rental property in an old ledger book, and he would handwrite them. And I remember one time Jack asking me, Garrett, I feel so bad just giving you all our, printed receipts and my ledger book. Would it be better if I just get a computer and I could track them that way? Jack, do you know how to turn on a computer? Well, no, that system won't work for you. What you're doing right now, Jack, that's the perfect system for you. So what works best for each and every one of you, figure that out, but you need to make sure you are tracking those expenses, because if you do not track them, I guarantee you the end of the year is going to come around and you will frustrate yourself to no end trying to go back over the course of the year, trying to track down those expenses. Here's a practical tip. If you haven't already and you have a business account. And with that business account, either have a debit card or a credit card and use that account exclusively for your business. At the end of every month, print off a copy of that bank statement for that credit card. You now have a documented record of every expense that you have related to that business activity. Your accountant will love you at the end of the year because you have a record and it's all in one place. Okay, so remember, ordinary and necessary, carrying on of a trade or business. I would add for everybody reasonably related to the production of income. Okay. Now we're going to skip around here a little bit. Okay. Garrett, where can I find a really good list of what can be an expense for my business? If you look in your own tax return, you will find an excellent list. And I don't know if I can zoom in and blow this up a little bigger, but I'm going to tell everybody where to find this. This is a Schedule C, C as in cat. And if you have a business, you are filing a Schedule C if you are a sole proprietor. If you are a single member LLC, you are filing a Schedule C. If you're an S corporation, that's at Form 1120S. It looks very similar to this. This section right here in the middle, it's labeled expenses. These are suggested categories of expenses that are related to a typical business. You can use this as recommendations to keep forefront in your mind what categories you could use as expenses. Now, there's one extra form if you're involved in real estate. That's a Schedule E as in echo. Schedule E also has recommended categories related to expenses for your business. Okay. One category I want everybody to be mindful of is right here, line 18. Depreciation. If you talk to any tax attorney or accountant, depreciation is the gold strategy for anybody working in real estate. Take advantage of depreciation. There are several different ways that depreciation can be utilized. The default rules are what are called straight line depreciation. If you have a residential rental property, you can depreciate that property over the course of 27 and a half years. That's a really long time period, everybody. I'm going to tell you all how you can accelerate that and speed that up. If any of you are involved in commercial real estate, the length of time is even longer. It's 39 years for depreciation under straight line. How can you maximize depreciation on property? I want everybody to write this down. Cost segregation studies. A cost segregation study, it's an engineering study But what it does is instead of looking at the piece of property as a whole, and when you depreciate property, you carve it up into these little slivers of value, and you can take one sliver every year over that 27 and a half years. Very long process. But with a cost segregation study, you look at the individual building components within that structure: flooring, wallboard, electrical wiring, plumbing, conduit, countertops, hardware on doors and cabinet doors, HVAC, your heating, ventilation, air conditioning. They'll even look at structuring within your roof. They'll look at shingles. They'll look at, how is your roof put together? These separate components, they all can be depreciated at different schedules, different lengths of time, many of them on a 5-year or a 7-year schedule. So now you're able to take a very large chunk of the value of that property and you can speed it up. You can make it faster. You can do it over a 5-year or a 7-year rather than a 27 and a half year period. Now, keep in mind there are some drawbacks to accelerating depreciation. If any of you have ever heard of what's called depreciation recapture, this is one of those hidden, ugly, nasty little gremlins that hides in the tax code that a lot of people aren't aware of. Accountants usually will not bring this to your attention. If you accelerate depreciation, you're taking it fast. When you go to sell that property, that depreciation you took previously, it now comes back into the calculation as to how much tax you realize on that property. Many people, they run in fear of depreciation recapture. No, why would we ever do this? If we're going to get hit with the depreciation on the back end. If you are in real estate, whether it be business or you have a portfolio, there is another tool you can use to be able to offset that depreciation recapture, and that's called a 1031 exchange. This is found within section 1031 of the tax code. If you have a piece of property and you sell that property, you're going to realize capital gain on the difference between your tax basis, which is the amount that you invested in that property, whether it be the cost to purchase that property plus the cost of any improvements you made to that property. The difference between that amount and the amount that you sell the property at fair market value, that difference is going to be capital gain. You're going to realize capital gain. You're going to pay capital gain tax on that amount. If you perform a 1031 exchange where you sell your first property and within certain time periods, you turn around, you identify, and you purchase another property for investment purposes, and that property is of equal or greater value than the one you sold, you can defer the capital gain and any depreciation recapture that is calculated in with that property that you just sold. If any of you work in commercial real estate, you already know that a 1031 exchange is the bread and butter tool in commercial real estate. You use this tool to be able to sell one property and expand your portfolio by purchasing 2, 3, 5 properties. The rule states the replacement property has to be of greater or equal or greater value. That doesn't mean you have to sell one property, purchase one property. The properties you purchase can be cumulatively equal or greater value. So let's say you sell one property and its value is $1 million. You now purchase 3 properties and each one of them, their value is $350,000, which gives you cumulative just over $1 million on those 3 properties combined. You've now used a tool to be able to defer any capital gain you'd realize, defer any depreciation recapture. You now picked up 3 more properties. You've expanded your portfolio, and everybody, you can wash, rinse, repeat. You can now do cost segregation studies on those new properties and start the ball all over again. And you do this over and over and over again. The IRS is very familiar with these strategies, cost segregation and 1031 exchanges, and they love them. To be honest, the IRS is fully on board with these strategies as long as you play within the rules. Okay? I want to get to this last point real quickly, and then I'm going to open it up for questions. I said earlier that in real estate, unless you are actively involved, your real estate activity is considered passive activity. In the world of tax, you have active and you have passive. Active income and active losses versus passive income and passive losses. They don't mix very well unless you're doing something to be able to unlock any of that passive activity and convert it to active. Any passive losses that you have, you get capped at how much you can use in any given tax year. It's about $3,000 in any given tax year if they're passive. Passive losses cannot be used beyond that 3,000 cap to offset active income. So let's play a scenario here. Maybe you have a W-2 wage job that you're working in addition to your real estate activity or your real estate business. W-2 wage for an employer, that's active. I'm going to throw you guys one step further. If you have an S corporation, remember you can pay yourself as the owner by distribution. As an employee of the S corp, you pay yourself as W-2. So now you've got these two components. You've got W-2, which is active. Technically, unless you're doing something to be active, your real estate activity is passive. So Garrett, how in the world can I unlock my real estate activity and make it active to where there's no limitation on that 3,000 passive loss? This is contained under section 469 of the code. These are the material participation rules. If you materially participate in a business, potentially that business activity can be categorized as active. And if it is active activity, any income to that business is active, any losses in that business are considered active. Active losses can offset active income. So Garrett, how do we get to active? Some of you may have heard of real estate professional status. In all practicality, everybody, it's a high bar. You technically have to have 750 documented hours over the course of a calendar year to have what is called real estate professional status. That is the gold level, okay? In fact, I'd even call it the platinum level in the material participation rules. If you have 750 hours and you're able to hit rep status, the sky's the limit for you. There is no limitation on your income or your losses in your real estate activity. They are all active. There's one extra part, though, to real estate professional status that's in addition to these 750 hours. You have to be participating in the real estate activity more than you do any other work activity. So if you have W-2 wage income, you have to spend more time in your real estate activity than you do in your W-2 wage job. This one is a little tricky because many people, they have a W-2 wage job. That's their primary source of income. They work 40 hours a week. If that's your situation and you want rep status, you have to be more than 40 hours in a week to be able to qualify for that rep status. It can get a little tricky. A way to work around this, to be honest, married couples work around this very easily. One spouse is a W-2 wage earner, the other spouse engages full-time in the real estate activity. Because you married filing joint, you now get the benefit of hitting that rep status. Now, Garrett, what if I can't hit 750 hours and get rep status? That's okay. There are 7 rules within section 469. You just have to qualify for one of them. There is a 500-hour rule. If you can hit 500 hours, you can unlock passive losses to the tune of 25,000 rather than just 3,000 in a year. Some of you have probably heard of the short-term rental loophole, where if you have a short-term rental, meaning you have a property and you rent it out for 7 days or less, Airbnb, VRBO, these types of properties. On these properties, you have to be able to hit 100 hours on that property. So much lower threshold, depending on your situation. If you can't do any of the hour thresholds, there is a default rule in the material participation rules. As long as you are actively involved with the property more than anyone else on that property, meaning you don't have a property manager. If you hire a property manager, guys, getting active material participation is probably going to be out. But if you're managing the property yourself, you probably are hitting that default rule of you are participating more than anybody else. Okay, I didn't leave nearly as much time at the end that I wanted to for questions. So we've got a few minutes here. Um,
You're
let
fine.
me,
It's okay. I do have Julio in the chat set. Can you repeat the business credit card thing again?
oh, absolutely. If you have a business account, that could be a checking account, and tagged with that, you've got a credit card, business credit card. Use that exclusively for your business. And then every month, download or print off a copy of that statement for that credit card. That automatically, you've got a record of all those expenses that you have related to that business. It's a little trick to be able with record keeping on your expenses.
Also, you can get credit card points and travel for free with that.
Michelle's right. Have any of you ever heard of credit card hacking? I know the terminology is terrible, and if Big Brother's listening, they probably would be like, "Oh no, you're." My wife years ago got into credit card point hacking.
hmm I love it.
Game changer, guys. Let me tell you, game changer. I don't think she and I have paid $1 on airfare or hotels in the last 3 years, and we've taken some pretty fun trips.
Yeah,
So,
the show.
game changer.
All right. Any other questions, friends? Feel free to raise your hand and we can unmute you.
I'm just
No,
scrolling through the chat to see if anybody else has any other questions.
no questions.
Some of
What?
you make good recommendations on some tracking software, FreshBooks, Hurdler. They're very user friendly, not very expensive. Um, Another one I talked earlier about, if you're going to be an S corporation, you have to have payroll. A really good option for payroll, cheap and expensive, very user friendly, is Gusto.
Mhm.
So if any of you are in that situation where you have to have payroll, it's good, simple software.
Yeah.
Good morning. I have a question.
Yeah, Anna Maria.
Um, so I am a real estate agent. My husband is a real estate agent as well. All the income, though, the transactions are in my name. Let's say if we travel to Florida, we're in Hawaii, we travel to Florida for a conference, and I pay for the tickets. For travel tickets. He is in my team. Can I deduct his travel ticket as well, or just mine?
No, if he's in your team, if he's part
He
of your group, your business team, and I know a lot of people use that terminology. Maybe you've got people working underneath you.
Mhm.
If he, for example, if he is a 1099 independent contractor,
He is.
then that sometimes can make a little bit of, tricky. But from a business perspective, if your business, you, Ana Maria, if you're paying for that, that's still a business expense. Basically, you're paying on his behalf, and you're saying, hey, I'm just, sponsoring you to be able to come and do this. But you can
Right.
still use that as a business expense.
Okay. So I'm getting pushed back from my
I,
accountant, and I would love to be able to tell him this is, based on this. Is there any way that where can I what part of the code, or how can I get more
section 162. This would fall under the ordinary and necessary uh, rule. Now,
okay.
yes, you might be getting pushback maybe from your accountant or for
Hmm.
somebody else from their position. They're probably thinking, well, that's not ordinary and necessary. You could argue, well,
Yeah, it's
he's part of my team. I have a
yeah,
team.
absolutely.
Whether or not my business chooses to pay for contractors to come out, to an event, my business can choose whether we want to do that or not.
Hmm.
So that's your position.
Yeah.
Yeah, talk with your accountant
Okay.
about that.
Okay.
Surprise, surprise, everybody. Accountants are not always the diehard line in the sand. If they tell you no, you can't do that, that does not mean no, you can't do that. So
Yeah. Yeah. Thank you. I mean, truly is ordinary. He helps me with marketing, and as we go on these trips, he's the one that's posts on social media and takes pictures and all of that.
yeah.
So it
Now
is necessary.
It is necessary. What you may need to look at, though, Ana Maria, is maybe, and this the example I used previously about if you go on a trip,
Mm-hmm.
what portion of that trip is business and what portion of that trip is personal. So you might want to look at that trip and see, okay, is there a component where your husband and you are doing maybe, just vacation touristy things for a day or two, as opposed to maybe a couple of the other days you're attending that conference. Accountants, they like to nitpick, they like to, split hairs, and
Mm-hmm.
they'll look and see, okay, well, what percentage of the trip was business? What percentage was personal? Maybe rather than deducting 100% of that airfare, maybe you deduct 60% of it because 60% of that trip you could definitely argue is business related, being ordinary and necessary. Just food for
Mm-hmm.
thought.
Right. And I thought that I mean, if I meet somebody as soon as we get to the location, an agent and then somebody else in between, and at the end, I should be covered 100%.
Sure. Yeah. Yeah.
Okay.
Be able to figure out how can I really
Yeah.
turn this trip into a business purpose.
Yeah. Yeah. Okay. Thank you so much, Garrett.
You bet.
Hey,
Any
Garrett, Julio here.
other
So actually, Ana Maria just brought up a phenomenal, amazing point, right? I'm a brand new agent. I just got my license about a month ago. And I know,
Yay.
yeah, let's do it, baby. So I 100% want to be on, so that when I saw this, and then I also saw Michelle over at the Austin rally. So she was phenomenal. And when I saw her with this class, I was like, oh, I know her. I know she provides good stuff. So let me get in there. You just based on Ana Maria's question and based on your response, you definitely are a tax attorney. Is there a, do you service Texas? Or is there somebody you have in Texas, San Antonio area, that we can go and get assistance with, right? Because I have a friend who's a CPA, but I'd rather talk to somebody that, just like you, are able to give additional explanation and be more in depth into what can be done.
So I work for a company called Prime Corporate Services, and we are a multi-faceted, multi-tier level company that provides various different business services. For everybody here, I'm going to put an email in the chat.
Yep, yep, yep.
Okay, so, and you guys can reach out to me, reach out to my team, and there might be some service that we can provide to you. I know we have various different services available. But Julio, for you, yeah, this would be a good opportunity for you to be able to, maybe ask, a question, if you need help or something. But let me throw that up there. So it's decoder@primecorporateservices.com. This is an email. So I head up the tax strategy division at Prime. We have a full service accounting group. They're called Insight. Very typical, accounting firm. But I head up a group that's called Decoder, and we do strategy, similar to what we've been talking about today. Garrett, what strategies can we use? How can I use the code to my advantage? How can we be able to maximize, tax strategy within my business? This email is monitored by my entire team. And so guaranteed, if you were to email us at this email address, you would get a response. The reason we do this is if I were to put my own personal email out here, guaranteed, I probably wouldn't see it for a week, just, with the hundreds of emails I get daily. This way, we have somebody that can get back to you very, very quickly, and be able to help you potentially with your questions. So.
Cool. That's awesome. Thank you. I know everybody was wondering, like, can you help me? So, all right. Any last questions, friends, before we head out of here? There's so much info today. Ah.
It is. Is he able to drop the link of um the Prime like his website or whatever?
PrimeCorporateServices.com. Is
I've
that it?
got
Yeah.
I've got
Yeah.
Andrea on here. Yeah, I think it's
Yeah, she's
Yep,
got
I
sometimes
can work on that, Garrett. Give me one
okay.
sec.
In fact,
Thank you.
Michelle, we could probably forward something to you that you could share. But yeah,
Yes.
everybody, I think it's just primecorporateservices.com. And of course, that's our landing page. You can go on there. I know there's links there that could get you connected to, our representative team and some of our directors if you wanted to go that route. Or, again, if you wanted to use the email decoder at Prime Corporate Services, connect with us. We could get you connected, to be able to help you guys, with whatever questions that you have. So,
I do have one more question if we have
sure.
time.
Yeah.
So I have a C corporation. Are the meals, if I choose to pay my employees' meals, is that a deduction?
It is. Yeah. There's two ways to look at meals. And as I said earlier, meals, typically the rule is you can deduct 50% of meals. Now, think of this as if I go out of the office, if I'm out and about, if I go out to lunch or go out to dinner with employees or with colleagues, or if I'm on a trip, if I'm traveling to a conference or an event, those are 50%. Ana Maria, if you have a brick and mortar office building and you bring food in to the office building, if you treat your employees to lunch and you order food in, that's a 100% deduction. So think of it, if I bring food in, it's 100%. If I go out, it's 50.
Okay.
Interesting.
But
Okay.
yeah,
But it still
meals
is
are,
deducted.
yep, food meals are deductible. Now, again, ordinary and necessary. Everybody, do not use this rule to pay for your monthly grocery bill. It's not going to work. Okay. So, ordinary and necessary related to your business.
Thank you.
Very cool. That's an interesting one. I didn't know the food in, the food out thing. I think that's super cool.
Yeah.
All right, friends. Well, thank you so much, Garrett. I really appreciate it. And by the way, guys, if you didn't know, all of the sessions that we do are recorded and they do end up on our YouTube. And then actually a couple of folks from Garrett's team, the rest of the services that they do have already done 2 classes for us, and those are already on our YouTube. So go check those out as well. And then we will be starting to make these classes that we do a weekly thing with Melnet. So by the way, and we can't do that yet until we have our board of directors nice and full because we just can't simply do it all. So if you guys are interested in applying for that or seeing what it's all about, visit expmailnet.com because we have our applications open until end of the day tomorrow. Just FYI. So, all
Awesome.
right, friends. Well, thank you so much for being here, Garrett. I really appreciate you. And then if you guys want a refresher on all this to go through it slow, a little bit later, it's going to be on YouTube. So go check that out. But thank you so much for being here. We'll see you next time.
Thanks, Michelle. My pleasure. Great to meet everybody.
Thanks, you too. All right, bye, guys.
Bye-bye.